Good afternoon, and welcome to session one of round two of the Omni Risk Return Industry Workshops. My name is Atul Mpandle. I'm a communications officer at the Financial Sector Conduct Authority, and I'll be your host throughout these workshops. Okay, so today here's how the session will unfold. I will introduce Marily Victor. Marily, please put on your camera so everyone can see you. Marily will be doing the opening remarks, and then we're going to have a presentation by Lorraine van Deventer, as well as Juanita Smith. Colleagues may kindly switch on your camera so people can see you, say hi. Thank you. And then we will have a Q&A session. In the Q&A session, we're going to ask that you kindly raise your hands, and then we will definitely unmute you and you can ask the questions. We also ask that you write all questions on the Q&A section at the top. You should see a Q&A tab there and not on the chat, because sometimes it gets lost in the conversation. Okay. Thank you so much. Kindly note that this workshop is being recorded and will be available on our YouTube. We hope that you have read everything from the communications to the memorandum. I see that people saying they can't hear. Can everyone else hear me clearly?
Yes, I can hear you.
Okay, I'm seeing thumbs up. And then the ones with no sound, do you mind dropping off and then just join the workshop again? Because everyone else is hearing me. We'll just give you a minute or two. Please drop off and join again. Let's just give them until 7 minutes past, please. Is that okay? One minute left, and then we'll move on to Marni. I'm hoping they have started to rejoin. Vukosi and Portretter, please drop off. Oh, but you were telling people to drop off. Vukosi, Mbambo, please drop off and then join again. Okay. Colleagues, I think it's fine that we move on to Marli. Marli Witzer, you may come in with the opening remarks.
Good afternoon, everyone. Thank you for joining us today. This is the second round of webinars that we are having. I think we finished the previous one yesterday, and each set consists of three specific webinars discussing different parts of the Omni Risk Return. We thought that it is important to mention a few remarks before we even start to go into the details of the Omni Risk Return. So please bear with me as I run through a few of these comments, which I think is really important to give context to the return as well. So the specific return is there to be completed by all supervised entities. There will be different functionalities that will eventually be written or placed into the return. For example, if a certain section doesn't apply to you already from the beginning, when you insert your name and you've selected your licenses, then certain areas would gray out. In other instances, if something doesn't apply to you, you will be inserting a 0 as an answer. So that functionality, especially the gray out, will only come later on. For now, it's very important to look at the content of the document, the way we ask the questions, And you will hear when Lorraine takes over, she's going to speak specifically to all the questions and the reasons why we're asking the questions, the specific risks that we're trying to address in the risk return. And that's why we included the specific questions. So it really is important that you look at the contents and the way we pose the questions. Very important, the risk return is a baseline risk rating tool. So the idea behind the risk return, the Omni risk return, is that we are able to, by asking similar questions or the same questions to the different sectors, to allocate a risk rating to each one of our entities, which is in line with international practice when it comes to supervision, right? Please understand that it's not the only tool that we use to supervise. This is but one very high-level risk rating tool, and there are other engagements that we will have with the different entities in terms of the risks and how we supervise them. So definitely, this is not the only return that we're going to ask for you. And then linking to this, very important, you are in some instances already submitting certain returns. For example, the insurance industry is submitting the conduct of business return. Some of the other sectors are submitting financial statements. You will have to continue submitting those specific statements or returns, even when we roll out the Omni risk return, as we do address different kinds of risks in those returns or statements that we're already requesting. To be very clear, there will not be an Omni risk return and an Omni CBR. The Omni CBR was the document that we published, I think it was about 2 to 3 years ago. And a lot has changed, specifically if you read through the documents that we published with the Omni risk return about 2 months ago. We very clearly explain why we had a change in terms of strategy, and that the Omni risk return basically now replaces the Omni CBR. So that will not be another document that's requested of you. The focus now is only on the Omni risk return. I spoke about the contents of the questions. Please consider the way in which we ask the questions. As I said, Lorraine will explain why we want the information. If you think that a question would not provide us with the relevant information, or the way we asked it is not going to give us the correct answer, then please tell us that in the comments. The comment is a space that we're giving now is really important for us to understand how practically this document will work for you. And you can even give us suggestions on how we could potentially ask the questions differently. There may be information that you are currently not getting that we are requesting in this risk return. If you did have a look at the previous Omni CBR, you will note that this Omni risk return is definitely a much more streamlined document with a lot less questions. So we definitely listened to the comments that we received, and we really tried to focus on the most important items that we think are risks that we need to address. And for that reason, we do ask that you work towards obtaining the information that we're asking, even if you are not obtaining it currently. If you feel that it's something that you will never be able to obtain, please comment on that and provide reasons as well, so that we can understand where you're coming from. Also know that these webinars that we're having currently will not be the only engagements that we have with the industry on the Omni risk return. We understand that this is a journey. We understand that you will have many questions even after this webinar series. And we also understand that the different sectors may require different methods in which we need to communicate with them on the risk return. So from next year on, we will definitely not just leave you to deal with this matter on your own. We will definitely engage with the different sectors and make sure that we align and adjust and accommodate the different sectors in terms of having further discussions on the Omni risk return. Please know that we must still make some final decisions on some of the issues related to the Omni risk return. One example would be the frequency of reporting. For now, we are thinking about maybe reporting once a year, but that could potentially change. or it could be different for different sectors. I think this is also something that we will discuss with the sectors as we continue with our engagements, and also as we roll out the pilot and look at the readiness of the different sectors in terms of being able to report. We are very aware that we are asking certain entities that are actually quite low risk to report. And we're also very aware that we're asking smaller entities to report on this return as well. We welcome any questions in terms of whether you feel that some of the questions would work, would not work, would not be applicable. And I think it's very important for us as part of the pilot to have some of the smaller entities engage in the pilot process so that we are sure that those entities are able to complete. And not only the smaller entities, we're talking about all sizes, all business models, so that we are sure that this is something that we will be able to roll out to all our sectors. And then very last comment, please make sure that you read and watch all the information that we publish on this document. It really does tell a story. And I think the more you read something about something that's new, the more it will become clear to you as we go along. That's it for me. Thank you, Atuli.
Thank you very much, Marilee. Just to piggyback on something that Marilee said, we recently published a few key documents on our website. So we have FSCA Communication 19 of 2025 that explains the consultation and engagement process. We also have the explanatory memorandum that outlines the purpose and structure of the return, and then the draft Omni risk return template itself. So which is basically the form, it forms part of the center of this project. If you haven't seen it yet, you can find these on the FSCA website. They form the foundation of what we'll be covering today and will basically help you have more context to the discussion. So today we'll be covering sections 1 to 4. When you write the questions, please keep that in mind. It's for sections 1 to 4. We've got a Q&A tab at the top of your screen. You should be able to see it there. Alternatively, you can write your question down and keep it, and when we do the Q&A, we will unmute you. We now ask Lorraine van Deventer to come through the presentation.
Thank you, Atuli. So firstly, I just want to thank everybody for making the time to join today's session. It's really great to see so much interest and participation, especially at this time of day. I'm going to walk you through the sections of the return that we will be focusing on in today's session, and I'll also touch on at a very high level why we're requesting this information and how it ties into our broader supervisory approach. So this slide gives just a quick overview of how the Omni risk return is structured. So as you can see, it's divided into 12 sections, each focusing on a different part of an institution's operations and risk profile. So for today's session, as mentioned by Atuli, we will be focusing on the first 4 sections. Section 1 covers group structure, ownership and shared services. So basically, who owns what, how entities are linked, and where shared services or dependencies exist. Section 2 looks at geographical presence. So that's where the institution operates, both in South Africa and abroad, and what that might mean for supervisory risk. Section 3 focuses on governance, and this is about leadership, oversight, decision-making, including composition and skills of the governing body. And then lastly, Section 4 deals with the nature of the customer base and politically exposed persons. In other words, who the customers are, how they're segmented, and whether there's exposure to politically exposed person or higher risk customer groups. So the note on the left is an important one. It's just a reminder that the same data point can tell us different stories depending on the context. For example, a high transaction volume might show strong operational activity and sustainability, which can be a good thing. But in another context, it could also point to higher risk exposure, which means we'd expect stronger controls and safeguards to be in place. So it's not just about the numbers themselves, but actually what they mean in the bigger picture. So if we move now to section 1. So this section focuses on understanding how the institution is structured. In other words, whether it operates independently or forms part of a wider group of entities. The idea here is to help us see the bigger picture, things like ownership, control, and decision making. So knowing whether an institution sits within a group gives important context for how it operates, how decisions are made, and where risks or dependencies might come from. So we ask institutions to indicate which of the three options best describe their structure. So that is whether they are not part of an organizational group, where they form part of a non-financial organizational group, and where they're part of a financial organizational group. If options B or C are selected, additional details must be provided, including the jurisdiction of the parent entity, the name of the parent entity, as well as a list of all entities forming part of the group must be provided. So we have defined by what we mean by an organizational group. It's quite widely defined to include a group of entities, irrespective of their institutional form, including companies, partnerships, trusts, associations, joint ventures, cooperatives, where they are connected either directly or indirectly through ownership or control. And it also includes a group of companies as defined in the Companies Act. So it's extremely wide, but intentionally so. A financial group, organizational group, refers to a group in which the financial institution that's completing the return, along with one or more other entities within the group, provides a financial service, a financial product, or a market infrastructure. In other words, an entity that's also supervised and authorized by the FSCA. And then a non-financial group, that refers to a group in which none of the entities, other than the institutions completing the return, provides a financial product, a service, or a market infrastructure. And all of these concepts are defined in the FSR Act. So section 1.2 focuses on understanding how an institution interacts with other entities within its group. And we measure that through financial transactions or shared services, rather. So the purpose here is to assess how much an institution depends on other parts of its group for funding, operations, or support functions. So high levels of interdependence can sometimes signal concentration risks or single points of failure, especially if one group entity faces challenges or suddenly withdraws support. So institutions here are asked to indicate whether they engage in intergroup financial transactions, such as loans, investments, or transfer of funds between group entities, and or whether they make use of shared so that's where key support functions like IT, finance, legal, HR are centralized and managed by one entity for the benefit of others within the group. And then they also have the option to indicate that they're not engaging in any of these activities. So if you select either A or B, you'll need to provide more detail. And that goes to the nature of the transactional services and the name of the counterparty. In other words, which group entity provides or receives the funds or services. So the two definitions at the bottom are just important to highlight. So intergroup financial transactions are basically any flows of funds within the same group, whether that's loans, investments, or profit transfers. And then shared services refers to a centralized model where functions like what I mentioned before, HR, IT, finance, are delivered by one entity for the rest of the group, with costs shared amongst them. So why are we asking this information? It's because these relationships tells us a lot about the institution's operational resilience and even transparency. So if too much is centralized or dependent on a single group entity, it can increase vulnerability if that entity fails or withdraws support. But on the other hand, well-managed shared services can actually improve efficiency and consistency. So again, it's not about judging risk in one direction, but here it's also for us understanding the context in which the institution is operating. So section 1.3 focuses on identifying whether any beneficial owner of a financial institution are nationals of countries that pose higher money laundering or terrorist financing risks. So the purpose is straightforward. It helps us understand whether the institution has ownership links to high-risk countries. So these links are important because they can signal elevated AML-CFT risks and influence how we assess the institution's overall risk profile. So institutions here must indicate whether any beneficial owner comes from a high-risk country or a medium-risk country or another foreign country that's not listed as either high or medium risk. So we have defined by what we mean by high and medium risk countries by listing the actuals, the specific countries under each one of those categories. And like I mentioned, this information just helps us flag areas where enhanced due diligence and or supervisory oversight might be needed. So now moving to section 2 in the return. So this section focuses on understanding the geographical footprint of the financial institution. In other words, where it operates both inside and outside of South Africa. So the goal here is to identify how widespread the institution's operations are and to understand any cross-border geopolitical or regulatory risks that might come with that. So a larger footprint usually also means more operational complexity and possibly higher risks, while a shrinking footprint, on the other hand, could point to financial pressure or strategic changes, especially when we monitor this over time. So this section is divided into parts, into 3 parts. In section 2.1, we require the number of countries where the institution has a legal or operational presence, categorized by financial and non-financial activities. In section 2.2, we require the institution to indicate its total number of business premises, both in South Africa and abroad. And we also require you to distinguish between financial services related business and other business activities. So that's non-financial services related business. We have provided a definition for business premises, and it's also quite wide, and it includes any location, offices, branches, call centers, or hubs that the institution used to run its operations, interact with customers, or perform management functions, and whether that space is owned, leased, and or whether it's just a temporary space. In section 2.3, we require the institutions to list the countries where they have a legal or operational presence. And it's important to note that if the institution operates in South Africa, it must be included in both the country count under the question 2.1, as well as under question 2.3. So in question 2.3, you must specifically also list South Africa as a country in which you operate. So we require this information because by knowing where an institution operates, we can actually better understand its reach, its risk exposure, both from locally and internationally. And this just helps us just also to support better supervisory coordination, especially for cross-border groups. Moving to section 3. So this section looks at the composition of the institution's governing body, who sits at the table, how independent they are, how diverse the group is, and what kind of expertise they bring. So we'll start with independence, the first factor that we consider. So here institutions are asked to indicate the number of governing body members in each one of these categories. For example, whether they're independent non-executives, whether they're non-executives, executives, independent or non-independent office bearers. So this information just helps us understand the balance of independence in the decision making in the governing structures. A board made up mostly of executives may indicate management dominance, while one with a healthy number of independent members suggests that there might be better oversight and objectivity. The next factor that we consider under the composition of the governing body is race and gender. Here you are required to provide the race and gender of the governing body. We collect this data because diversity directly supports better governance. It brings different viewpoints and experiences that ultimately strengthen risk management and decision making. So over time, this information will also help the FECA track progress on institutions' transformation plans, particularly around leadership representation. The last category that we consider under diversity and composition is skills. So here we ask you to classify your governing body members according to their primary area of expertise. The categories include financial skills. So that's, for example, accounting, audit, financial analysis, or actuarial. We look at operational or non-financial skills, regulatory compliance or consumer-related skills, and lastly, governance and leadership skills. What I would like to highlight here is that you should actually do a self-assessment on in determining the skills categories of your governing body members, but it should be based on objective evidence. So things like their qualifications, their prior experience, or demonstrated competencies. So the aim here is just to get a sense of whether the governing body has actually the right mix of skills to see the institution's operations and manage both conduct and financial risk effectively. So finally, we ask you to provide the total number of governing body members. This just allows us to calculate the proportions. For example, how diverse or independent the board is overall. So this section isn't just about ticking boxes. It's about showing that the institution's leadership is balanced, diverse, and capable. So section 3.2 looks at how remuneration, particularly fixed and variable remuneration, is structured and whether it supports fair customer outcomes or encourages excessive risk-taking. So under paragraph A, we require institutions to report the guaranteed portion of remuneration. So that's things like base salary and benefits. So this just gives us a baseline understanding of the non-performance-based component of remuneration. Under B, institutions are required to provide details on variable remuneration. So this is usually refers to performance-based remuneration. So for example, here you would include bonuses, share options, or profit sharing. We are also asking you to indicate whether the remuneration is linked to qualitative measures like customer outcomes or compliance, or where the remuneration is not linked to such qualitative measures. So, for example, purely sales or financial performance. There's also space to capture other remuneration, which might include once-off or discretionary payments that don't neatly fall into fixed or variable categories. So finally, we ask for the overall total across all the categories. So that's fixed, variable, and others. So we can assess the overall structure and balance. The balance between fixed and variable components will tell us a lot about an institution's culture and risk incentives. So for purposes of the return, we defined what we mean by some of the terms used in the return. And we've defined fixed remuneration, variable remuneration, and qualitative measurements. And like I said, fixed remuneration refers to the guaranteed part of remuneration, so salaries and benefits that are not tied to performance. Variable is performance-based, and qualitative measures are non-financial performance criteria, things like treating customers fairly, complying with regulations, maintaining ethical standards, etc. So this focus on how results are achieved and not just what results were achieved. So the goal is here to assess whether an institution's remuneration practices support good conduct or encourage excessive risk taking. So, for example, if a variable remuneration dominates and it's not linked to qualitative measures, it could indicate a sales-driven culture where short-term targets may outweigh customer outcomes. But on the other hand, where incentives are tied to things like customer satisfaction or regulatory compliance or ethical behavior, that may signal a more healthier customer-centric culture. A common question is why we can't just get this information from the annual financial statements. So the reason is that that the annual financial statements, the data is usually aggregate and provided at a high level. It doesn't necessarily break down the remuneration structures or show how incentives are linked to qualitative measures. So this return gives us the granularity and the consistency that we need to compare across institutions and to identify institution-specific conduct risk. So Section 3.3 looks at how institutions monitor and manage non-compliance incidents, and importantly, how these incidents compare to the organization's own risk tolerance levels. So under A, institutions must report the total number of non-compliance incidents during the reporting period. A non-compliance incident is any event, intentional or unintentional, where the institution fails to comply with applicable laws, regulations, rules, standard policies, or contractual obligations. And this may include a wide variety of breaches of regulatory requirements, policies, or industry codes of conduct. In the next part, we ask for the number of incidents that went beyond the institution's risk tolerance threshold. And we have defined risk tolerance level as the board-approved threshold that defines how many incidents the institution is willing to tolerate before it becomes a concern. So for an example, if an institution allows up to 5 minor breaches a quarter, but records 10, then 5 of those would exceed its tolerance level. So for us, tracking both total and above tolerance incidents help us assess whether the institution firstly have defined and board-approved risk tolerance levels, whether it has a system in place to detect and record breaches, and whether it has effective mechanisms in place to manage and remediate issues before they actually escalate. Also, a consistently high number of incidents, especially those exceeding risk tolerance levels, can indicate weak compliance culture or inadequate oversight or even ineffective risk management practices. And it also helps the FSCA to identify entities that might need supervisory intervention or a deeper review. Section 3.4 focuses on how institutions respond to non-compliance incidents. In other words, what corrective actions are taken and how quickly those actions are completed. So the main idea here is that it's not just about identifying when things go wrong, it's also about how effectively and promptly they are fixed. So the first question looks at the total number of remediation actions taken during the reporting period. And the second question focuses on how many of those actions were completed within the organization's targeted time frame. So from a apologies. So from a supervisory point of view, this gives us insight into an institution's compliance culture and capacity. So if remediation is consistently delayed, it can suggest weak governance or poor accountability or even limited resources in compliance and risk management. Conversely, timely and effective remediation reflects strong internal oversight and commitment to fair conduct and regulatory integrity. So ultimately, the FECA uses this information to identify where persistent or slow remediation patterns may point to deeper problems, which could include cultural resistance to accountability or over-reliance on manual corrective processes. Section 3.5, here we focus on understanding an institution's exposure to professional, cyber, and operational risks, as well as the adequacy of its insurance and guarantee covers to manage those risks. So here you are required to indicate the number of claims and their value against the different types of risk policies. And we've listed a few here. So we look at professional indemnity. So that's usually covers losses from negligence or professional errors. Fidelity insurance, which relate to employee fraud or theft. Cyber insurance, which help cover data breaches or cyber incidents. And guarantees that were invoked during the reporting period. We also ask for information on fraud or misconduct incidents that didn't lead to an insurance claim, because that still gives us valuable insight into your control effectiveness and culture. So the purpose here isn't to check whether an institution is legally required to have insurance or whether you have in place. It's about understanding your risk exposure and your resilience. So as an example, if you have a high number of claims here, could indicate to us weak controls, poor oversight or systemic issues, while limited or no insurance cover could mean the institution may struggle to absorb financial losses if incidents occur. So it's really, this data is going to help us identify whether institutions have adequate risk transfer mechanisms in place and whether there may be any underlying vulnerabilities in your governance, your culture, and your operational resilience. So moving to the last section that we will be covering during today's session. In section 4.1, we focuses on understanding the composition and economic scale of your legal entity customer base. In other words, the different types of business or institutional customers you serve and their relative size. In paragraph A, institutions must report the number of company customers grouped according to their annual turnover. There are 4 turnover bands listed in Roman 1 to Roman 4. These categories just gives us an indication of customer size and scale. So larger companies typically is likely to have internal expertise and less vulnerability to poor advice or unfair treatment, while smaller ones, I think especially those under 2 million, may rely more heavily on intermediaries or may even lack the expertise to fully grasp some of the complexities relating to the products or the services they engage in. From an AML perspective, we also use this information because customers with larger turnover or high transaction volumes generally poses greater money laundering or financing risks. So beyond companies, the return also asks for the number of customers that are trusts, partnerships, organs of state, retirement funds, or other entities that are not natural persons. So this just helps us build a comprehensive view of the types of clients operating in the market, whether they're public sector bodies, investment vehicles, or other types of institutions. And also each one of these types of customers have different risk profiles and conduct expectations. So, for example, with trusts, they often carry higher AML CFT risks because of complex ownership structures and hidden ownership structures. And then retirement funds and or organs of states might carry governance or fiduciary responsibilities that require a high standard of oversight. So it's important, I think, also just to mention here that the turnover thresholds are not meant to align with the SMME thresholds under the National Enterprise Act. That act was designed for economic policy and enterprise support and not necessarily for assessing conduct or customer outcomes. So our focus is on how the size and type of customer influence the inherent risk of an institution's activities. These categories or thresholds just give us a practical and a consistent way to group customers by their relative size based on our assessment of entity vulnerability. It will also help us identify whether products and services are being appropriately targeted, distributed, and supported, and whether certain customer groups may be more exposed to conduct risk than others. So finally, financial customer is broadly defined. In the return, it's reference to the definition of financial customer in the FSR Act, and it includes anyone to whom a financial product or service is offered or provided, as well as beneficiaries. So institutions should use this definition when deciding which relationships to include in their reporting. And then perhaps also just to mention, having this section helps us see who institutions are serving. So from the small private companies to large corporates and institutional clients, and to understand how that customer composition affects your conduct risk. If this information is not yet readily available, institutions are expected to collect this as part of strengthening their own understanding of the customers that they serve. Having this information will enable you to develop a more complete view of your customer base, which is essential, I think, for designing and distributing products that are appropriate for the size, the capability, and the needs of the different customer groups, and as well as assessing affordability and suitability, particularly where products or services may carry financial or operational risks. Section 4.2 focuses on individual customers or natural persons and groups them by income or affluence level, as well as by politically exposed person status. And the purpose here is to help us understand both customer vulnerability and AML CFT risks. So from a conduct perspective, a high proportion of low-income or mass-market customers can indicate higher risks related to affordability, product suitability, and potential mis-selling. And then from an AML CFT perspective, customers who are politically exposed increase AML, CFT, and reputational risks. So institutions need to apply enhanced due diligence and stronger internal controls when dealing with them. The customer segmentation category, so that's low, medium, and high income, are not about asking institutions for precise income data, but rather for obtaining a general understanding of customers' financial capability and product needs. Institutions in categorizing your customers, you can use recognized frameworks like the socioeconomic measure, that's SEM, which classifies consumers based on living standards and access to resources and not only just income. This will allow for more consistent and comparable reporting across the industry. So we do welcome feedback from industry on whether it might be useful in the future to set clearer monetary thresholds or to formally adopt the SEM classifications to ensure alignment across sectors. Then lastly, before I conclude, so this section focuses on identifying customers and their beneficial owners who are linked to jurisdictions that are on the FATF grey or blacklist. The purpose is to measure an institution's exposure to high-risk jurisdictions. So customers or beneficial owners connected to these countries usually pose significantly higher money laundering and terrorist financing risks. So when an institution has a high number of such customers, it suggests potential AML CFT vulnerabilities, particularly if controls around due diligence, monitoring and reporting are weak. So these exposures would directly affect the institution's AML CFT risk score and will likely draw closer supervisory scrutiny. The information also helps the FSCA to identify where potential risks are concentrated. It will assist us in making sure our monitoring focus on checking whether there are appropriate enhanced due diligence in place, as well as how much reliance is placed on high-risk jurisdictions for business or investment relationships. So this isn't really about restricting institutions from doing business with such customers, but it's about making sure that where high-risk relationships exist, the right controls are in place, and that the enhanced monitoring does take place. So that concludes my part of the presentation for today. Thank you for listening, and Atuli, I'm going to hand back to you. Thank you.
Thank you very much, Lorraine. I'm going to ask that Juanita Smith comes through.
Thank you, Atuli, and good afternoon, everyone. Welcome at our webinar. I'm going to speak to the timelines and how the Omni risk return fits into the bigger picture of IRS and the development of IRS in the FSCA. Some of the points that I'm touching on was already touched on by my colleagues, so sorry for that, but we have to repeat it and then it's easy to remember. So as you know, we're busy with the consultation process now up to the end of November. By then, all comments should be received on the Microsoft template that we sent out. It will not be accepted through any of the emails that are sent to the inbox or on any PDF or Word documents, only on the template. It makes it easier for us to consolidate and analyze and then also take what we need from it so that we can be on time for the timelines of the pilot. Therefore, we ask that all be submitted in that manner. So we have these workshops that we are having with industry. Like Atuli said, this is our first one of the second round. We also have targeted engagements where it is requested. You are welcome to send a request to our inbox with the questions that you might still have and a proposed agenda, and we'll try and accommodate as much as possible. Again, capacity is the issue. That's why we are trying to answer as many questions as we possibly can during these workshops. I see that in the Q&A session, there is a lot of questions already. We're trying to answer them as much as we can. Then if we look at the overall IRS implementation, so IRS is probably the biggest project that the FSCA has done. And it's very important to our supervisory leg, especially. So the first phase of the IRS was where we built in all the existing returns, the ones that Marley referred to, that are already statutory returns and are being submitted by the various entities in the different sectors. That was built onto the system, and we did testing on it. And in phase 2, where we are now, we have also considered how we could possibly streamline those returns to make it applicable across sectors and make it a little bit user-friendly to complete, but also because we're going to use some of that information in the risk model. This is a soup text solution for the FSCA to make us more proactive, help us see emerging and overarching risks, but then also to plan our supervisory plans more accurately. In phase 2, except for the consolidation of those returns where possible and looking at how it could be built for COFI in the future, we're also working on the risk model and the risk return. This is the return that we are now discussing with you that have been built on the system and has been connected to the risk model where there will be risk ratings. Now, there has been questions with regards to whether we will make risk ratings known to entities or to the industry. No, we will not. That is for our own supervisory purposes and our planning in the year. However, during our engagements with entities, it will be clear on the frequency alone, whether you are in a higher category or in a lower category and what the reason for that may be. During the testing phase, we did see some areas that we wanted to improve before we go on to the pilot with industry. And that is, we're doing a second round of testing now on the return to see that it works well with the model and that we get the results that we're hoping for. Early next year, we don't have a date yet. We are going to start engaging industry on the pilot. You are more than welcome to already send us a request to the inbox if you want to be part of the pilot. Like Marie said earlier in the session, we do want to have presentations of all the sectors and all the sizes of entities. But we do need you to also approach us and say that you are willing to take this next step with us. We will be giving you enough training, and then the pilot will hopefully end by the end of August next year. This, however, does not mean that the submission of the return will start at the end of August next year. I saw there was a question also regarding when will the first return be due. So the IRS needs to be fully built and implemented before we could be able to send out the returns and start analyzing the data, because we need the system for the data to come in and be analyzed. And that has not been finalized yet. We're also starting with the third phase, the final phase of the IRS, which is the licensing phase and other supervisory activities. During this phase, we're trying to build all application forms or notifications that you do currently also onto the system so that that could also be automated. Therefore, at this stage, there's no definite date about when will the first submission be, but we can say that if you look at this chart, it does not mean that it's at the end of August next year. But you will continue doing all your other reporting on all your other statutory returns in the meantime. Thank you, Atulia. I think I answered all the questions I could with this slide for now. I'm handing back over to you.
Thank you very much, Juanita. We will now move on to the Q&A session. To make sure we hear as many voices as possible, we're going to be working in cycles. So first, we'll take 3 questions from participants who raise their hands. So please do raise your hands if you would like to ask a question. Then we'll take 3 questions from the Q&A section. If you've typed your question on the chat, please copy and paste it in the Q&A section. Please don't hesitate. Your questions are an essential part of this process. So let me have a look at the people who have their hands up. Lorraine, you may stop presenting. Sure. Thank you. Let's see. We've got 2 hands up so long. Can we please have one more? There. Okay, perfect. Let's start with that. We'll start with Margaret. Margaret, you may come through.
Thank you so much. Can you hear me?
Yes, we can hear you.
Okay, fantastic. So first of all, thank you so much for the presentation. And sorry, I'm trying to multitask here. There's lots that's happening at the same time. So just quickly, if you don't mind, I have got 2 questions. The first one is on 4.4, and I actually also put it into the question and answer session. So currently, the process is that we use nationality, citizenship, or residency to determine risk. We don't use whether a person is from a grey or blacklisted country. And what we're not clear about in this regard is what is meant with from. Because you could be a South African citizen working in a grey or blacklisted country. That doesn't mean you are from. So trying to gather this data is going to change institutions' operational models completely, which will impact their RMCPs heavily. And I'm not sure whether that has actually been thoroughly thought through. So that's the first question. And then the second question is if I can go to the number of customers per legal entity, 4.1. So in this regard, sorry, I just want to get to my note here. So how are we going to deal with this? Because you can't have retrospective application, okay? It's absolutely impossible to want to try and go back and obtain information that you don't necessarily have. And maybe a good example to use here is turnover. So we've got this requirement of you have to report in accordance with turnover for companies. However, companies' turnover consistently change. There again, if the thinking is that that is something that should be tracked consistently, it's not something that's being done. It's going to mean huge system enhancements and amendments. And it's again completely going to change operating models and strategies of financial institutions. So just some clarity in that regard, I'll greatly appreciate that. Thank you so much.
Thank you very much. Colleagues, I just want to make sure you've taken notes before we move on to the next person. All good? Lorraine, Marlene, Juanita?
Yes.
Okay.
Yes, Cecily, we are taking notes, but maybe it would be easier if we could respond after each.
Okay, that's fine. We can do that.
After a participant's questions. I think that might make it easier.
That's fine. You can proceed.
So I see Michelle's hand is up, so I'm sure that she's going to come in on the AML CFT parts of the question.
Can come through, Michelle.
Good afternoon, everyone. I hope I'm audible.
You are.
Let me just move all my screens around. Yolani, yes, thank you for the question. I can see where you come from in terms of what is it exactly that we mean, whether a person is from. Does it mean they live there, they were born there, are they working there, are they doing whatever there? That being said, I'm sure we are open to see how we can better phrase that or better explain the expectation so that it's clearer in the mind of the person that has to complete the return. That's probably the short answer. The longer answer is it's leaning more towards institutions that are not collecting that kind of information. So geographic risk is part of the factors inherently that institutions should be considering when they conduct the MLTFP of business risk assessment. And geographic risk obviously goes further than to just also make the distinction between foreign and local. And if in the case that it is foreign, a certain jurisdiction's geographic low risk, location risk will be impacted by whether they're grey or blacklisted. And that's, I've actually answered another question in the chat as well. Other things we also consider is the risk and context of MLTFP of risk in every jurisdiction. So you might have jurisdictions that's actually not on the grey list, for example, but we still have serious concerns just because of their location. They're known to have high volumes of cash or gold flowing through them or the like. So open to any and welcoming any comments you might have with regards to in your written response or comments on how we can better phrase it. I think we can also apply our minds to just make it clearer. Thank you, Chair.
Thank you very much, Michelle. Margaret, does that answer both of your questions? Because you had two.
It answers the first one, but not the second one. Thanks.
Let's move to the second one then. Colleagues, is there anyone that can come in for the second question?
Thank you, Atili. Maybe, I don't know if Michelle would like to take the second question as well. That's the breakdown of the thresholds that we apply to companies from an AML safety perspective.
Yeah. I don't know actually how to articulate it better than Lorraine, your high level notes or comments that you provided in your presentation. The higher the turnovers, the higher the transaction volumes, the potential for risk is just higher, unless I'm not clear on the question.
Maybe I can come in and just try and clarify. So threshold doesn't really tell you much, because threshold, if you want to apply turnover thresholds, it consistently changes. There's a lot of other control mechanisms that are already in place to determine the risk factor of a company, trust, whatever legal entity you are dealing with. But thresholds in the sense of turnover it's impossible to consistently track and update your systems accordingly. So you can only deal with that aspect at a certain point in time when a customer comes to apply for a product or a service. And then you apply your other control measures to actually determine from an anti-financial crime perspective whether this company does pose a risk. And to the point that you've just made, I mean, you will look at things like, for example, Michelle, from, in what country do they operate? Who are their UBOs? Where is the head office situated? So there's sufficient other control measures that give you that same information that you need. And I think in this regard, where the concern is coming in, and I'm speaking purely from a banking sector perspective, so I need to clarify that, but we already have the Prudential Authority who supervises those aspects. So now you have two systems running that requests different information, and you can't run two systems to try and fight financial crime. So I just don't think this is something that's really practical to actually track by. It may be worthwhile to maybe rather look at what do you already have that can be used, and we will happily make some suggestions in that regard. So I hope that clarifies it, Michelle. So I just want to understand, how did you guys get to the point of thinking that turnover thresholds is the solution for the risk that you're trying to address? Because I don't think it is. And I do think there's sufficient other control measures that actually do address that risk. I hope that makes more sense. Thanks for the indulgence.
Thank you, Lalani. Thank you for your patience with me getting to understand the question better. I only have two responses really. One being, I don't think that this is like the alpha and omega factor that we put here. We would want to see that together with the other things we ask for and build a picture. Secondly, and Lorraine and colleagues need to correct me. I don't know if banks would not have to respond to this from an AML perspective. But I don't know if from a market conduct perspective, there would be the requirement. So then I have to push it to you to assist me here.
Yes, so thank you for that question, Marguerite. It does provide us with valuable insights regarding the practicality and availability of the information. I think so. What you have mentioned is purely from an AML safety perspective, but what I'm keen to understand is how do you assess and how do you categorize your customers from a conduct perspective. And like I mentioned during the presentation, understanding your customer, understanding their size, their vulnerabilities, it will help you in designing and distributing products, identifying your target market. So I hear that you collect and engage with your customer at onboarding, but surely there are some additional engagement taking place of the customer over the life period over the life of that relationship. And surely there are engagement and marketing regarding other products that the bank offer. So perhaps just from that context, how does the bank categorize their clients to make sure that its target audience is appropriate for the products or the services that it's marketing? And that could then assist us in refining and reconsidering that question and to see how to make it more practical. Thank you.
Thank you very much, Lorraine. Margaret, I just want to, can you please give me a thumbs up? You sorted?
Yeah, for now, thank you so much.
For now, okay. Thank you. Timberlisa, please come through. You're not on mute, but we can't hear you. So I just want to double check if you're speaking.
Am I audible now?
Now you are.
Thank you so much. Apologies for that. Yeah, so this kind of follows on Marguerite's question. So she asked from a 4.1 perspective, which is about companies, and ours is also about the natural persons. Can a similar approach be taken in that maybe we provide suggestions to the FSA to consider alternative conduct points, just because it's not currently a business requirement for the business to understand the income levels of our customers. So we don't offer tiered products per se. So we might have maybe minimum investment or lump sum investment amounts for the products, but not necessarily the income level being tracked for natural persons.
Thank you, Timberlisa.
Thank you. And then can I also maybe just raise one last one? At 3.2, there's performance and the incentive framework regarding the remuneration disclosures. And this particularly for executive directors. Is there an alternative data point that can be considered for the FSA, particularly for private companies or P2I LTDs, as this information is confidential, and as you can imagine, our executive directors would not want to share this sensitive information.
Thank you. Lorraine and Marley or Juanita, you may come through for that. Then we'll move on to Evelyn.
Okay, not sure if any of my colleagues would like to take this question. I can just switch on their cameras. Okay, if not, I'll attempt to address it. So the first question, there's Marley. So yeah, so on the first question, happy to consider any input from industry on the classification of the customers. Happy to understand how institutions are currently categorizing their customers. So and like we explained before, similar to the institutional types, surely that type of categorization is currently taking place. You need to understand the type of customer you are serving. So what factors are you currently considering? On the natural persons, we try to steer away from specific income thresholds. So that's why you'll see it's at a very high level, low income, mass market type of explanations. So happy for you to make some suggestions in that regard, and we will definitely consider. As regards the last question, and that's on 3.2, that's the remuneration variable and fixed. We understand that information is sensitive and that it's confidential from an institution's perspective. We would just like to remind you that any information that you share with us will be kept confidential by the FSCA, and we will not make any information available unless it's at an aggregate level across the institution. So maybe just to give some comfort in that regard. But I see Marley is camera's on, so she definitely has would like to make some comments as well.
Yeah, thanks, Lorraine. Just maybe on the first question as well. So I think in our mind, when it comes to any sort of financial planning for any client, doesn't matter whether it's a life or a non-life product or investment, it is important to understand what the person is earning to be able to understand what they really want to do with their money, if it's an investment, or if they want to take out a life or a non-life product, whether it will be affordable and whether a product won't lapse, and in our mind, that is a conversation that you will have with your client, and as part of that conversation, you will understand an income level. Also understand that some of these questions, as Lorraine said, we are going to use to be able to understand our entire financial sector, right? So from it, we'll be able to then draw aggregate information to see which clients are purchasing, for example, which products, if you look at specifically what they're earning. So some of this is not only to obtain information from you, even though it is to see what type of clients you are dealing with, but then it is to have a look and see what is going on in South Africa in the market conduct sector, specifically overall. But I mean, again, if you feel very strongly about any of those points, then do put it in the comments and we'll consider that.
Thank you, colleagues.
Thank you.
I believe that answers Tembelihle. I'm now going to move on to Evelyn. Evelyn, please come through. Evelyn, you're on mute if you're speaking. Evelyn, can you hear us? Okay, while we're waiting for Evelyn to sort out their mic, is there anyone else who would like to raise their hand? Just one more person. All right, you can come through.
Thank you so much. So if I can maybe just ask under 3.4, if you guys can just please help us by clarifying. So when you say reporting non-compliance incidents, are these all non-compliance incidents, or is it only non-compliance incidents as it relates financial sector laws? And maybe to use an example why I'm asking this question. So if an institution is non-compliant with the National Waste Management Act, how will that provide the FSCA with insights into an institution's conduct towards its customer? Because it could be a very specific matter that the institution is dealing with. That has got nothing to it's got nothing to do with its conduct towards its customers. And the thing I think we should keep in mind is numbers are very powerful without context. So if you can just also elaborate on how the FSCA will then get context about what sits behind the numbers of non-compliance incidents. Thanks.
Thank you, Marley.
Thank you for the question, Lorraine. And just keep me honest here, but my understanding is that the non-compliances relate to the legislation that we as the FSCA currently supervise. So we're not going to ask you to report on waste management as well. It's with regards to our legislation. Lorraine, do you agree with me on that one? Not. Okay, I'm going to then let Lorraine answer that one. Thanks.
No, so we have defined what we mean by non-compliance incident, and it refers to any act, omission, or event that results in the failure to adhere to applicable laws. So anything applicable or to that institution, and it includes rules, standards, policies, and even contractual obligations. And I think the reason why it is so wide, because remember what we're testing here is not how compliant you are with our laws. That's not what we're testing. What we're testing here is your culture, your compliance culture, and your capacity to remediate any non-compliances. So do you have the controls in place to actually mitigate breaches? So that goes to culture and capacity, and ultimately all of that could impact on conduct as well, because it could signal poor governance structures or poor oversight or monitoring or a lack of effective controls that are in place. So that's why it is quite wide, but happy for you to comment and to give us specific insights as to why you believe this is not appropriate in assessing an organization's culture and governance. Thanks.
Maybe can I come in as well, Atule?
Sure.
I just wanted to say, as part of my answer, I also wanted to say that, remember what I said in the beginning, this is a very high level risk rating document. So it's going to give us an indication. We will obviously have some tools running in the background that'll give us a risk rating, and potentially some items could be flagged. But what we will use that for is then to have a discussion with the entity about what is standing out. It doesn't mean we're going to come in guns blazing and we're now going to enforce you. We want to understand what are your challenges, maybe why are we seeing certain numbers going up, because eventually we would like to measure one period, a risk rating from one period to the next, and sometimes we may see something go up or we may see something come down, and we would like to have those conversations with an entity. So it really is just an indicator to have a conversation. It doesn't mean the conversation is going to be bad. It also helps us as the regulator to understand practical things that the industry entities are struggling with, because it's sometimes easy to be a regulator and write laws, but not really understand how the laws implicate and affect an organization in their day-to-day practice.
Thank you very much, Marilee. Evelyn, I just want to make sure that I just want to check if you still want to ask a question or not, because I see you put your hand down. Evelyn? Okay, nothing from Evelyn. Juanita, my keyboard warrior, I'm going to ask that you please come through and read some questions from the Q&A section that have not been responded to.
Atuli, I saw a comment that popped up while Marley was speaking. Again, I just want to, on the previous question, remind everyone We said we're not there to enforce other laws, and we understand where our mandate begins and ends, but this is to measure the culture of an entity. Then relating to new questions, I'm going to give some of the AML questions to Michelle. One is blacklisted countries are not defined. Is this the intended FATF countries, Michelle? And what if the risk of the countries change? There's another AML question. That is why we know we need you in these sessions. They say at 4.2b, where we're asking about the customer segmentation and we're asking about PEPs. The question is, when counting PEPs, do you regard the client, the organization, as a PEP if they have a related party as a PEP? And what should be recorded where there are more than one PEP as a related party? This is from Lauren Lee. So I don't know if you need more information on that, but it's the counting of PEPs in question 4.2b, where we need to give numbers. Then there was a question for retirement funds, where it was asked if we, and the mutuals also had a question very close to that, to ask if we see members as customers for them. And in our minds, we do, from a conduct perspective. Your members, whether in a pension fund or for a mutual, we do see as your customers. Because my understanding is with a mutual, all of those members will be saving money and using the services of the mutual, even though they are taking part in the management of the mutual in many instances very actively, but they will remain customers for which decisions need to be made. So to answer that question, I think a lot of the other questions in between was answered with this discussion that we had now regarding the segmentation on companies and also for the natural persons. And like we said, we invite all comments to try and make it even easier for you to split your book of business. Michelle, I'm going to leave you with those two AML questions.
Yeah, thank you, Janita. I'm not sure. I'm answering the questions in the chat. I'm not sure if my responses are not visible. But be that as it may, with regards to 4.4, blacklisted countries not defined, intended FATF countries, what if the risk of the countries change? Clearly, I mean, there's even certain prohibitions when it comes to blacklisted countries. And I have posted in the chat in response to that question, just a link to the specific page on the Financial Action Task Force's website where they explain and define what a blacklisted and a grey listed country is, and they actually provide the lists. If we should further update our terminology sheet, we can certainly do that. But yeah, that thing I think is answered. With regards to the one on PEPs, so the way we see it really is that a PEP is a natural person, be that foreign or domestic. So they should be counted as natural persons. And if you also look, remember with the General Laws Amendment Act of 2022, both the naming convention and the definition was changed. It's now once a PEP, always a PEP. And it still extends to the family members and known close associates of a PEP. So those are the people who would be impacted. Thank you.
Thank you, Michelle. Actually, we're handing back to you. Maybe just to also say that we highlight some of these questions. If more of the similar questions come through on the chat and you weren't able to see the answers, then we'll highlight some of the questions. Thank you, Atuli.
Thank you, Anita. May we have more hands? Would anyone like to ask a question? Please put your hand up. Let's have a conversation and not just one-way presentation. We'd love to hear your inputs. Please put your hand up. Okay, we've got 2, 3. Perfect. Thank you so much. We'll start with Avita Maharaj. You may come through.
Thank you so much. My question is in response to 3.4, or rather, my question relates to 3.4. And that question speaks to the total number of compliance remediation actions taken in response to non-compliant incidents. I just wanted to confirm if there's multiple remedial actions being taken for a single non-compliance incident, should the institutions be reporting each action individually, like total actions in totality, or should it be reporting on a one-to-one basis based on the incident? Noting that the following question then speaks to a similar sort of question, but based on whether it's within the targeted time frame.
Thank you, Avita. Colleagues, may we answer the question? I will do one person and then answer.
Thank you, Atuli. I'll come through. So yeah, that is a very good question, one that I don't think we have properly considered. So the intention was to capture and to get an understanding of whether you have remediated the breach or the non-compliance incident. So coming from that context, if that remediation involves a number of activities or a number of steps, I would only count or regard it as complete once all of those activities or steps have been finalized and the breach now has been fully remediated. So from that context, I would see it as a one-to-one. So this was the non-compliance, and the question is, has it been remediated? Yes or no? But this is a good question, and we will definitely consider how we can provide more guidance or make it a bit more clearer in the return itself. Thank you.
Thank you so much.
Thank you, Lorraine. Lilani, you may come through. Becoming a celebrity, you may come through. Lilani, you're not on mute, but we can't hear you. So just want to check, are you speaking? You can give me a thumbs up if you can hear us.
Sure. Can you hear me now?
Now we can hear you perfect.
Welcome
back.
Thank you. I have a new headset where you need to pull in and out the mouthpiece, and I forgot that I pushed it back, so my apologies. So thank you very much, FSCA team. I really enjoyed this afternoon session, and I posted quite a few questions in the box Q&A, but just on your risk tolerance levels. The question I asked there is, if we put it through a stress test a little bit, how will we explain in which areas we are willing to tolerate which risks? What is the governance bodies, and this needs to link directly with the governance bodies' risk appetite statement. How do they define risk? So this is, in my view, where compliance and risk comes together. You can't look at compliance in isolation from what the risk appetite statement is. But then also the non-compliance incident, I did look at some of the comments in the chat box and the questions that we've asked. My humble view is when you look at compliance, you can't look at the compliance through the lenses of just, and I say this in inverted commas, a face compliance officer. It's broader than that. You have a massive regulatory universe. You have a massive regulatory universe that applies to your entity. And this is where I understand the comments, Jonita, that you said it signals the company culture of the entity. If you look at those chapters in COFI, it's about governance, compliance, and risk, and you can't really separate it into little, you get a pocket, and under your cheek, there's a free car, like Oprah would say. You have to look at all three together. So I think my comment is more that I understand where you're coming from, Jonita, but I think we need to maybe ask for a little bit more in terms of the risk tolerance. Maybe link that to the governance section to understand what is the risk appetite statement. From the governance body, what levels of risk are they willing to accept? More a comment, and then one question. I know you responded to it, but I think it is still worth asking it because it's creating confusion. If we look at the terminology tab, I know we didn't chat about it today, but the terminology tab refers to tight intermediary and independent intermediary. And if we go back to 2014, can you believe it was 7 November 2014, RDR came out, and one of those proposals was about advisor categorization. So does it mean if you've got a terminology tab now, independent, intermediary, and tight intermediary, that the RDR advisor categorization proposals are no longer, I don't even know if it was effective or in effect or in, yeah. So that's my question, but thank you. At the risk of bubbling too much, thank you for your time.
Thank you. Colleagues?
Okay, so I'll step in on the RDR tied and independent agents, and Lorraine could maybe come in there if she wants. So yes, there was proposals in the RDR. I can also not believe it was 2014, and we had different structures, and it was even layered further, and other definitions and suggestions given. But yes, it was, yeah. And there was a lot of work done on that work stream. But the definitions or descriptions rather that we're using in the return is not linked to RDR at all. And it's also not there to position anything for in the future. These are descriptions to only help you complete and understand the return, and the way that we want you to count and calculate in the return itself. So yes, it's definitely not linked to any movement coming or anything with the RDR. And the RDR, those proposals never came into effect when it comes to the segmentation of the advisors. Many other proposals on the RDR did come into effect in some of the other subordinate legislations and changes that we've made over time. Relating to your question about that we could ask more or be more specific on the risk tolerance to get the culture question more specified. We take note of that. Please also put that in your comments when you submit your comments. It's a good point. Thank you. Lorraine, do you want to add?
No, that's fine. Thank you, Juanita. But maybe I see we have some of our colleagues from RFD online. Maybe they would like to come in on the RDR and where what is happening with that process or where the work is heading. I see Lezon is up. Thank you. Sorry, Atuli, maybe can Lezon come in?
Yes, thanks.
Yes,
I've been
she may have just
unmuted.
enabled
Am I
her mic now.
audible?
Yes, you are.
Okay, great. My camera is probably not going to switch on, but I hope you can hear me. So with regards to the RDR, I mean, Juanita covered it. So the purpose of definitions in this is for purposes of understanding the return. It's not legislative definitions. It does not replace legislative definitions. And with regards to what is going to happen to the remaining proposals of the RDR, I'd like to refer you to our regulation plan. So we publish an annual regulation plan. And the intention is still to incorporate some of those proposals that were consulted on as part of the transition of the work to COFI. But as Juanita and Lorraine and a couple of colleagues mentioned, the regulatory framework has moved on. So instead of trying to, in isolation, implement the RDR proposals, we're going to incorporate it as part of the transition, which will then apply to across sectoral to the relevant sectors. So these things should be considered in isolation. What was under the RDR proposals will still be considered as part of the work we're doing under COFI, but it's not meant to replace anything that's in this risk return. The intention of this risk return, and I think it was said a couple of times today, is to establish a baseline risk measurement for the entities that we regulate. I also see these comments around us overstepping and going beyond our mandate. I don't necessarily agree with that because we're not saying we're trying to implement other pieces of legislation over which we do not have a mandate. As Lorraine said, we are establishing a risk per financial institution. so that we can more effectively and based on that risk supervise these entities. So please keep that in mind when you do comment on the return. I hope that clarifies the point regarding the RDR. Thanks.
Thank you very much, Lazon. Appreciate it. Ryan, please come through.
Can you guys hear me?
Can hear you, but you sound a bit far.
Sorry, can you hear me better now?
Still sound far on my side. Can anyone else just confirm?
And it's soft on my side as well.
Okay,
It's quite
sorry,
soft.
I'll try to speak a bit louder. Thank you for
Okay.
your time, everyone. I just wanted to ask, I did have a few questions I posted in the Q&A. Sorry, and I got some responses. I just wanted to ask on business premises, see, Juanita did respond, but just if a financial institution doesn't have any offices at all, like everyone works from home, including the owner of the company, will the answer for that be 0 for like business premises, or will the owner's house be seen as a business premises? And so then there'll be 1 sort of, and then the answers that aren't applicable for this different financial institutions, do they just leave those answers blank, or are they required to put in an input? So will it be 0 if it's not applicable to them, along those lines? And then just one more. I see Michelle answered for grey-listed, blacklisted countries. When it's time for the return, will there be like a definition or a link to what the current grey-listed and blacklisted countries are at that time? Or will it be something the financial institutions will have to go on the FATF website to just check at the time they submit, saying that these are the grey-listed, blacklisted countries, and that they don't have anyone from them at that time? Or is there something you guys will provide, like a drop down or like a link to it, sort of thing?
Thank you, Ryan. Just want to confirm if everyone heard that question. Are you fine? Okay, Juanita, you may come in. I see you nodding. Do you have the answer?
I'll take a first stab and then Lorraine can
Sure.
come in. So yes, as you rightly point out, I did answer it in the chat, but for everyone's benefit, if you look at the terminology sheet, we do define what is business premises. And I'm not sure if it was your question, Ryan, or someone else's, because there was a few questions surrounding this, saying that everyone works from home, and do you count then all the homes of the employees? No, because that would not fit into that description that we have, and it won't help us to see your footprint. However, you have to put in a 0 in all the fields that are not applicable to you. But as a legal entity, you would have a registered business address. So you would have at least 1 address that you have registered with CIPC and with us for all your correspondence. And although that might not be business premises in the way that it's described in the terminology, I wouldn't say that you should make everything 0 because everyone is working from home. I would say there would be at least 1 registered address. But no, not all employees working from home should all count as business premises, except if they fall into, if you look at the description, I just want to have it here in front of me. If you look at the description, it does say when would something like that fall into. So if it's offices of administrative or that's doing where administrative or management functions are being performed, or a physical location used predominantly or primarily for operational, strategic, or service delivery purposes. But from the questions that I read and understood, it's just normal employees working from home. Lorraine, do you want to come in?
No, I agree, but one will have to assess. So look at the factual circumstances. So if you have employees working from home, or if you're an institution or financial service provider working from home, and you are conducting your business from that space, so either engaging with customers, etc., etc., you will most likely have to record that as a business premise because it will align with the definition of business premise. So just keep that in mind. But that will, I think, if you just purely do administrative or persons doing administrative activities, that would not be regarded as a business premise. But for some of those activities, I would definitely record or reflect it as a business premise because you are conducting your business or part of your business from that premise. Thanks.
Okay, and then to the question, Ryan, about the drop-down list. Michelle did touch on it, and she did provide the link in the chat about where you can see blacklisted countries, grey-listed countries. I just want to answer the bit about a drop-down. So you can't see it now in the template that we send out of the return wherein you have to make your comments because there's no functionality in that template. But we will provide you with a drop-down of all the countries and all the questions where we're asking you to indicate the countries. There'll be a drop-down and you can mark the countries that you are doing business in. Whether they are grey-listed or blacklisted, that is what you need that link from Michelle for. And that link will be updated all the time. That's not our responsibility as the FSCA, but our responsibility as the FSCA is to ensure that we have all the countries on our drop-down list. And that's why we also provide that catch-all other. If there is a country that we don't have on there and you're using that country or you're present in that country, that we know that we need to add it for future versions. I think that answers all your questions, Ryan. I'm not sure.
That should. Ryan, you fine? Ryan's quiet. Sometimes when you're quiet means you're fine, right? So I think we can move on to Margaret. Margaret, just to confirm, do I pronounce your name Marguerite or Margaret? I just want to make sure.
No,
So I don't
it
butcher
doesn't
your
matter.
name.
It really doesn't matter. Don't worry. Most people just know me as MJ actually. But it's Marguerite.
Okay.
But please don't worry about it.
Marguerite. Okay, please come through. Apologies.
No, don't worry about it at all. So I think, first of all, thank you so much for the confirmation. And I think it was you and Nita or Michelle, I'm not sure, who responded, or it could have been Marilee, but around your willingness to look at the definition of beneficial owner. I think it's really important for that definition to align with what we currently have in the other existing legislation. So thanks for that, guys. Otherwise, we're going to run two systems there, which is not going to work. And on that basis, if I could maybe ask if you could please do the same with the definition of control, because we already have a definition of control in the Companies Act, yet there are different definitions in, for example, the Insurance Act, etc. So if we can just also make sure that that one is aligned. And then I'm not sure to what extent this will help, but it borders on what Ryan also asked. So if you look at the countries that's, for example, currently listed in just the draft version risk return, it's already outdated when we compare it to the current black and grey list of FATF. So it may actually be better to maybe link the definitions merely to say, the grey list or black list of FATF instead of actually trying to list those countries, because otherwise it's also going to mean a lot of updates that consistently have to take place. And in that regard, maybe a further proposal is to see whether it's not worthwhile to define high risk and medium risk a little bit better by also linking it to, high risk potentially the blacklist of FATF and medium risk, the grey list of FATF. And that can then also help clarifying. So just a few proposals. And then just one more question around business premises, please. So business premises is defined, but what is not defined is legal presence. Can we just perhaps better understand what do we mean with legal presence, please? And then just the last question, and sorry, this was actually part of one of my very initial questions, and I forgot to say that this one hasn't been responded to, but I'm still concerned about when we speak about turnover thresholds for companies, what do we do because we can't go back retrospectively to gather that information? And also the risk associated with that turnover consistently changing. What the thoughts about that is. Thank you so much.
Thank you, MJ. Let's see if there's anyone, Lorraine, who camera's on, which means you've got an answer for us.
Yes, so happy for my colleagues to come in. But thank you for the comments on the definitions or the terminologies. We'll definitely take it on board. Please just include it in your comments as well. On the question of what does legal presence mean? So legal presence is usually refers to where you are domiciled, where the entity is registered. So the company, the country of registration, and the country where you may have an operational presence is different from where you have a legal presence. So that's the distinction. If it's necessary to provide more guidance, happy to do so. And then just on the thresholds, company turnover thresholds. So Marguerite, we do understand that you can't go retrospectively go back to your customers, but surely if you have an ongoing relationship with that customer on an ongoing basis, you need to understand what type of customer you are dealing with. You need to understand the vulnerabilities, etc., etc. In order for you to conduct further business with them. And that's assess appropriateness of marketing, assess whether whether they should form part of a targeted group, etc. So my same question remains similar to what I've posed earlier. Currently, what are you using from a conduct perspective to categorize your customers? So maybe if you can give us some clarity on that, we can further respond, but happy to consider your concerns during the if you could highlight your concerns in your comments, we can address it in there as well. Thanks.
Thank you, Lorraine. Juanita, I think we can take 2 more questions from the Q&A, and then we'll wrap it up.
Thank you, Atuli. Yes, I'm going through the questions and thinking which ones did we answer by writing an answer and which ones did we do verbally. But I think the 2 last questions that we need to do is firstly the question around digital presence, Lorraine. In section 2, do we consider digital presence? That would be the one, and it's Lilani, I think, that raised that one, if she wants to come in and do a follow-up question on it. And then there was another one. I was scrolling to make sure that we kind of cover everything, and then I lost that question. But so, Lorraine, I'll give that one for you so long, and then I'll go to the next one.
So if the question is whether the institution need to record the countries where they have a digital presence under the question I think it's 2.2 relating to physical locations, that's business premises, the answer would be no, because of how we have to find what we mean by business presence, business premises. So a digital presence would not meet the criteria of that definition. If it speaks to question 2.1, and this is where we want to know whether where the countries in which you have a legal or operational presence, I think the digital presence would then be covered. So here it would fall under operational presence. So I would suggest that if you have a digital presence in any other jurisdictions, it should be recorded then under section 2.1.
Baie dankie. Appreciate.
And maybe, Lorraine, before you leave, to also just, I found the other question and it links into that, but maybe just to clarify on question 2.1. If retirement funds have members that are abroad, will that mean the retirement fund has operational or legal presence abroad? This came from Anita, if she wants to add more to it. My understanding, based on what you said just now, if there are members abroad, it would be operational presence. All right?
No, so the question does not speak to where your customers are based, because that would be where your customers are based. It's where you conduct your activities and where you perform your business. It is a difficult question because if you service your customer and that customer sits offshore, legally, where is the activity being conducted? I don't have the answer right now. I don't know if my colleagues from RFD would like to come in. Otherwise, we can consider and then provide a response during the feedback process. Lizanne, I don't know if you would like to come in.
Apologies, Lorraine, I missed the question, to be very honest.
So the question is, if you have offshore customers, and you need to indicate whether the countries where you have an operational presence, would you say that the countries where your customers are based should be counted as countries in which you have an operational presence? For me, that's a bit of a technical legal question because that's not exactly what we ask. But the question is, if you service your customer offshore, where's that activity taking place? Is it still taking place in South Africa, even though part of that activity is being performed offshore? Or are we going to say, or is it a matter of the activities performed in South Africa, so the operational presence should be limited then to South Africa, and so far it relates to offshore customers?
So I agree with you that that's a legal technical question, Lorraine. I think we probably need to give it some further consideration because the complexities around, if you have an offshore presence, where you have a license, where you're allowed to operate, all these types of things come to the fore. So I think point taken, I think we can maybe just clarify exactly how we're trying to capture that. But I wouldn't want to give a definitive view now. It's just going to cause chaos. Thanks.
Thank you. Yeah, I agree with you. Thanks, Atuli.
Thank you very much, Lorraine and Lizanne. It is now 4:56, so I think it's safe for us to wrap it up now. Thank you all once again for joining us today and for the continued engagement in the Omni risk return process. Your questions and participation are not only appreciated, but essential in shaping a reporting framework that works for all of us. This concludes the first session of the second round, and we actually look forward to seeing you guys in the next workshops. Until then, stay connected and thank you for being part of this important journey. Have a great day.
Thank you, everyone.
Thanks. Bye.